Today's market action is turning negative once again, as Treasury yields continue to climb and the IWM, representing small-cap stocks, struggles badly. IWM is down roughly 1.5%, which shows how much pressure the broader market is under. Despite this weakness, AMC stock is actually trading higher today, which is interesting and worth taking a closer look at. In this video, we're going to break down all the major reasons behind the overall market decline, what's driving investor sentiment, and how AMC is holding up in the middle of all this volatility. So let's jump right into it. If you're new to the channel, make sure to subscribe, hit the like button, and feel free to drop your questions, concerns, or feedback in the comments section below. Now, something important happens whenever a company is expected to report earnings later in the week. AMC is scheduled to release its earnings report on Wednesday, and historically, when a stock performs well before earnings are released, it often suggests that investors are expecting positive results. This doesn't guarantee anything, of course, but over the years, I've noticed a strong pattern. When a stock rallies into its earnings date, more often than not, those earnings turn out to be solid. On the flip side, when a stock lags or sells off heading into earnings, you frequently see disappointing results. To me, this simply indicates that certain investors, those with deeper industry insight or more sophisticated analysis already, have a sense of what the report might look like. Again, this isn't financial advice. If you want actual trading or investment guidance, you should consult a licensed professional. I'm just sharing observations based on years of watching market behavior and individual stock reactions around earnings season. Unfortunately, the broader market today is sliding lower. There are several reasons for this, and one of the biggest headlines involves a major financial institution group bank, which is reportedly considering laying off 10% of its employees. When large banks start cutting staff, it raises concerns about deeper structural problems. It suggests that perhaps the internal expectations for economic activity, demand, or overall business performance are weakening. And if big banks are preparing for a slowdown, that's usually a bearish signal for the market. Another reason for the market drop comes from JP Morgan's latest outlook. According to a note shared with clients, they believe the recent stock market rally is unlikely to continue into year. In their view, the risk-reward setup for equities is becoming unattractive. They argue that markets may soon begin pricing in a possible policy mistake by the Federal Reserve specifically, the Fed keeping interest rates higher for longer. If that happens, it could push long-term yields down, but not in a good way. Instead, it would signal economic weakness. And if long-term yields fall because of recession fears or declining growth, stock prices could suffer significantly. The JP Morgan analyst also mentioned that if earnings estimates for 2024 start deteriorating, that would add even more pressure to equities. They currently hold a neutral stance on mining and technology stocks, but recommend reducing exposure to retail, automotive, and construction sectors. They prefer overweight positions in industries like telecom and insurance, which tend to perform better in uncertain or higher rate environments. While seasonal trends usually support stocks at this time of year, JP Morgan believes that any boost from peaking bond yields may be temporary and might not translate into a lasting rally. We also heard from the Federal Reserve today, specifically from Fed member Cook, who expressed a relatively optimistic view. She suggested that markets are simply giving back a portion of the strong rally we've had recently. If you look at the chart, the index has been up for 5 consecutive days, 5 straight green candles. So, this pullback doesn't necessarily indicate a trend reversal yet. The market hit resistance at the 50-day moving average and slipped a bit. But in the broader context, it's still holding up reasonably well. Personally, I think the markets could remain tactically bullish into the end of the year, unless something dramatic pushes us toward a recession. This is why I don't believe it's a good time to be heavily short or overloaded on put options. Again, this is not financial advice, just my personal stance. Looking into 2024, however, it might make sense to consider some downside protection, because next year could be extremely volatile. Now back to AMC. The stock is performing particularly well today, and I believe that's mainly due to optimism around its upcoming earnings report. AMC is once again testing the same resistance level it struggled with on Friday. If it manages to break above this zone in the next few days, that would be a very bullish signal. A strong earnings report could easily push AMC into the $20 range. Even moderate or better than expected earnings could move the stock substantially higher, with AMC currently priced around $11 per share. There is definitely a significant amount of potential upside if the earnings come through stronger than expected. Now, let's dive deeper into AMC's numbers and options activity to see what the underlying data is telling us. First of all, there were two impressive orders totaling over $13.5 million, both with a 100% positive order value. That's a bullish sign because large orders like this usually come from institutional investors. And institutions don't typically throw money around without doing rigorous analysis first. Looking at the volume expiring this Friday, we currently have 73 in overall volume, with calls making up 45% of the activity and the rest distributed across other positions. Open interest is around 69% calls, which is significantly higher than puts. This is very different from earlier this year, from January to September, when there were nearly 3 times as many puts as calls. During that period, AMC kept getting pushed down every time it tried to rally, mainly because heavy put positions and high short interest created downward pressure. Today, however, the option chain looks much more bullish, even though you should take these numbers with caution. I don't think they're perfectly accurate. They are still meaningful. The put-to-call ratio is sitting at 0.66, which indicates that calls are dominating the options activity. When calls outweigh puts by this much, stocks often move upward because market makers hedge their positions by buying shares. Now, let's take a closer look at AMC's short interest. There are around $38.6 million worth of short positions on the stock. The days to cover sits almost at 0, meaning shorts can theoretically cover quickly. Roughly 12.93 million shares are currently sold short. Short interest outflow is about 6.54%. Around $15.57 million worth of shares were borrowed recently, and the utilization rate is around 35.91%. With a short score near 52, again, I wouldn't fully trust these numbers. They seem inconsistent, especially given the recent price action. For example, the average cost to borrow AMC shares is showing under 1%, which seems unrealistically low for a stock with increasing upward momentum. Borrow fees close to 6% make more sense. No rational market maker would open a short position at 1% when the stock is trending upward. So once again, take these reported numbers with a grain of salt. Examining this Friday's options data, we see around 15,000 in-the-money calls and over 152,000 out-of-the-money calls. In comparison, there are only 2,300 in-the-money puts and 29,000 out-of-the-money puts. This means calls overwhelmingly dominate puts both inside and outside the money. That kind of skew often leads to upward momentum. Now, stepping back to the broader market once more, the primary reason for today's decline has been the surge in 10-year Treasury yields. The 10-year bond is now yielding nearly 9.5% more. Bond auctions happening this week are also contributing to the volatility. Today, we had sales of short-term bonds, the 3-month and 6-month auctions and there, with significant selling pressure. If the bond auctions continue to underperform throughout the week, it will be bad for equities because weak demand for bonds pushes yields higher, and higher yields typically hurt growth stocks and overall market valuations. Bond yields actually dipped slightly during today's auction, which explains why they are rising so sharply now. The 10-year Treasury is up nearly 10 basis points today. And even though this may simply be a reversal, it still puts downward pressure on the stock market. Before the market opens tomorrow, several companies will report earnings, including Real Estate Income, NXP, Diamondback, Power, and more. After the close, we'll see earnings from companies like Clover, Katera, Uber, Celsius, Datadog, Emerson, Dr. Horton Mel, ACM Research, Vortex, Fibrogen, and Celin. My son actually shares the name Celin. We still have some time after hours, and remember that AMC reports its earnings on Wednesday. I haven't taken a position in AMC yet, but if you want alerts when I do, you can follow the link in the description. You'll also receive notifications when I make other trades.